Reality check. You're working harder than ever, but everything's more expensive, less accessible, and just out of reach. Why? Today's guest, Paul Musson, is here to pull back the curtain to show how our financial system really works and who it's working for. If you're ready to understand inflation, money, and wealth in a whole new way, this episode will change how you think about financial freedom. Welcome to the Manifestation and Money podcast, the show where we tackle the taboo topics of money and manifestation. I'm your host, Jenni Schultz, former 9-to-5 grinder who ditched the status quo and went all in on creating a life I love. Yes, I use manifestation. Yes, I took action. And yes, I created a 7-figure net worth before turning 40. Every week, I'll bring you inspiring stories with money mavens and manifestation masters. From learning how to make more, save more, and grow your wealth to unlocking the power of manifesting your dream life. I am so excited to play in this space with you. Let's jump into creating a life you love. Welcome to the Manifestation and Money podcast, Paul.
Well, thank you for having me.
I am pumped to chat with you just because in essence of what I read about you in kind of our little lead up here, I'm intrigued. And I always love it when I have a guest come on that I'm intrigued about. I would love for you to start off by sharing with the audience who you are and what your story is.
Sure. Brief background. I was born in North Wales and grew up in Montreal. And like many Anglophones in Montreal, I made that trek down the 401 from Montreal to Toronto because I wasn't fluently bilingual. It's my own fault. And just started looking for work. And I was sleeping on a hardwood floor of a bachelor apartment, working at a video store at nights, and I was 29 years old, and that's how I got my start.
Oh.
And so I like to tell young people that don't be in a rush. Don't think you have to be here by this age, or you know what I mean? There's so much pressure these days to do what everybody else is doing, or you're supposed to be on a set schedule. No, just follow your dreams, take any job you can get, and do no harm, and be passionate, and good things probably will happen. And it's a long story from the video store to where I ended up in my career, which was a portfolio manager, a manager of mutual funds. And so researching companies, analyzing companies, and managing portfolios. And then I was managing a team of portfolio managers at Mackenzie Investments. And our funds were called Ivy funds, very high quality investments we would make for our clients. And very long-term investing. The goal was to help get our clients to their long-term financial goals. And there's two parts to that. First, you have to invest properly. You're going to make mistakes, but hopefully have more successes than you make mistakes. But then you also have to communicate very clearly to your clients about what it is you do, who you are, so they will have trust in you and they will believe you that you will do what you say you will do. Yeah, so that's sort of my background. And then about 2 years ago, I left Mackenzie, and because my big passion became communication and writing. I had started writing a book to explain what was going on in the world because I was just getting very frustrated at what was happening. And most people, I don't think, understand truly what's going on. I started writing a book that would be easy for pretty much anyone to understand. You don't have to be in the finance industry. You don't have to be an economist. I'm not an economist. I studied economics for the last 15 years. Yeah, so it's written for people who are not in the industry. And so my wife has already read it a couple of times. She's just as angry as I am now. My daughters have read it. And so I use lots of analogies. We go step by step, chapter by chapter. But I can get into that later. My book is called Capital Offense: Why Some Benefit at Your Expense.
Mm-hmm.
And then in June of 2022, I started a blog, and it's called Political Economy instead of political. Paul, my name, like puns. Political Economy, and it's a weekly blog. It's free, sort of deciphering what's going on. Have a little bit of fun with it as well. And I've had great feedback from people in that. And I've got CEOs and chief investment officers and lawyers, and I've got teachers and nurses and students. And people say, I like the fact that you don't talk down to me. You know what I mean? And so I'm not trying to impress people. I'm just trying to help people understand. I love it. It's so much fun.
I am so intrigued by this book because the current landscape that we're dealing with is not the same landscape that my grandparents grew up in. And things are shifting and changing. And I think people are feeling it in the sense of things are inflating, our grocery bills are getting more expensive, and almost just sitting back waiting for things to course correct. But I think we need to understand a bigger picture and understand what is happening in the economy, because I think people are just almost not really ignoring it, but in a sense ignoring it because we don't know. We need more people sharing about what is happening in the economy and why and what factors are playing into it, just to wake us up to seeing what is actually happening. So if you'd be so kind to share as what your thoughts are and what you're seeing is happening. And I know people, yes, will definitely be sharing the book so they can dig into it deeper, but let's start this conversation today.
Yes. Okay. Well, thank you. So, no, you're exactly right. Like people are frustrated. They know they're getting screwed.
Mhm.
They just don't know how.
Right.
And so, particularly younger people. And so they're angry, but they don't know who to be angry at. They know the system isn't fair. And there's a saying, an old saying, that the people always get the government that they deserve, right? You vote them in. Well, the majority who voted get the government they deserve, the ones who did. But even them, the people only get the government that they deserve if they actually know what's going on and then vote accordingly. People don't know what's going on. They cannot vote accordingly. So they're not getting the government that they deserve. And it's not about left, right. It's both sides. It's the monetary system that's the problem. The problem is what I call fallacious economic doctrine. It's policies that are very short-term in nature, and that policies that want us all to believe that there is such a thing as a free lunch, something for nothing,
Mm-hmm.
that yes, debts and deficits don't matter. Yes, you do need inflation for an economy to function. No, you don't. Inflation of any level is very bad, but governments have convinced people that inflation is necessary for an economy to grow.
Right.
It's false.
Right.
It's not a conspiracy. I believe that the people who are making the decisions actually have good intentions. They think that these decisions are going to lead to longer term economic prosperity. They won't. What they do is they lead to short term positive symptoms. And so if the central bank all of a sudden prints trillions of dollars, all of a sudden GDP rises. GDP is all it is, a measure of final spending in the economy. If you print trillions of dollars and hand out checks to people, they go spending, then GDP goes up. I can explain later why that's not a good thing. And also, if they print trillions of dollars, stock markets go up. And so they look at the symptom of a rising stock market, and a politician will say, well, look how strong the stock market is. I must be doing a great job running the economy. Well, no, that's just the central bank printing money and buying bonds, which eventually leads to higher stock prices. And I can talk about that, how that works. And all these things I talk about in my book, but very slowly, step by step, so you understand. But the reason that a lot of politicians accept these fallacious theories, A, because they're not economists. Most aren't. Some are very clever. But economics itself is not a natural science. So a natural science is like chemistry or physics, stuff like that. Economics is more of a social science, like psychology. And so there are different schools of thought within economics. And some schools of thought definitely recommend inflation, spending money and debt and all this kind of stuff. So of course, politicians are going to naturally gravitate to whatever schools of thought are going to make them look good in short term, especially if there's an election cycle coming up.
Right.
But the other reason all this happens is that most people don't understand the real concept of money. And it's far more complicated than you think. I think I've got 3 chapters slowly going through what is money. It's not money that makes the world go round. It's capital. So let me differentiate those two for you. Capital is anything that you produce. So your podcast, you're producing, this is a capital that others will consume.
Okay.
So, and it could be a good or a service, but let's say you make suits and I make bikes. We're creating real capital. You make a suit, I make a bike, and then we exchange that with each other. Now I've got one of your suits, you got one of my bikes. We're both better off because we created capital. There was no suit or bike in the economy. Now there's one of each. The economy is that much better off. We've exchanged that capital and nobody else is worse off, right? That creation of capital and our benefit didn't come at anybody else's expense. There was a mutual benefit there. That's how the market system is supposed to work.
Right.
Increasingly, it's not working that way. People are benefiting at the expense of others and are doing so in a number of ways. What enables this is that you and I don't do a direct exchange, like barter exchange. I don't sort of knock on your door. Okay, well, here's my bike. Give me my suit. You're going to sell your suit for money, and I'm going to sell my bike for money. Now, let's say you sell your suit for $1,000, effectively what you have in that $1,000 is one suit, right? You're storing up your capital, that suit, in your $1,000. That's why your $1,000 has value, because you created capital and you exchange $1,000 for the capital you produced. So the money is called the medium of exchange. Money is what we use to exchange all the capital that's being created around the world. Capital is what makes the world go round, not money. Money is very important. I couldn't function without it. But you can have all the money in the world, but if you got no capital, you're done.
Right.
You can have a lot of capital and no money, you still be okay. It wouldn't be a well-functioning economy. But let's say you make 10 suits and you sell them for $1,000 each, and you've got $10,000 in your bank account. Essentially, you've got 10 suits, capital stored up in that $10,000. But you're not going to spend it right away. You're going to go on a vacation at the end of the year. But before you can go on vacation, the central bank doubles the money supply. Now, when a central bank creates money out of thin air, there's no capital in that money. The central bank did not create any capital to obtain that money. It's all digital, right? Presses a few buttons.
Yeah.
It's money that has no capital. But as soon as it comes into circulation, it extracts capital from the rest of the money that's already in existence. When they double the money supply, that new money extracts 5 suits from your $10,000. So you still have $10,000. So you don't think you've been ripped off, but it only contains half as much capital. It was only worth half as much as it was before the central bank doubled the money supply. Now your $10,000 will only buy half as much as it would have done before. And that's inflation.
Yeah.
Now, going to double money supply overnight, to crash the economy, but I'm just exaggerating for effect. So capital is extracted from people without their permission and in some ways without their knowledge. And that's why the title of my book is Capital Offense. So things really started to unravel, if you will, from a fairness perspective. This is my opinion, back in 2002. So during the 1990s, there was this dot-com boom, technology stock market bubble. And stock markets were going through the roof. The Fed had lowered rates to too low levels for too long. That also contributed. And stocks were very, very expensive. And this was contributing to what's called a wealth effect. When stock markets are rising, people see their portfolios gaining in value, feel wealthier, then they'll often use that inflated stock portfolio as collateral for loans and then go and spend that money, which increases GDP, the final spending numbers. Central bankers were witnessing that, saying this is a pretty good thing. And then they would give you every quarter how much the wealth effect contributed to GDP growth. Isn't this great? So now they got to keep the stock market growing because they don't want to have a negative wealth effect when stock markets come down. But that's exactly what happened. There was the dot-com bubble burst. Stocks fell about 50%. And there was a negative wealth effect hurting the economy. But it wasn't a big effect. It was a very mild recession in the US in 2001. It was only one quarter actually of contraction. Typically, a recession is defined as 2 quarters, successive quarters of negative GDP over 6 months. It's only 1 quarter. Anyways, there were market commentators who were saying that the US Federal Reserve should start another wealth effect. But this time they should do it in housing. So drive housing prices higher And then people who own homes will feel wealthier and then borrow on their home and go spend that borrowed money, and that will boost GDP, the final spending. So that's exactly what the Federal Reserve did. They dropped rates down to, I believe it was 1%, which is extremely low by historical standards, and kept it there for 2 years, I think it was, despite the fact that the US economy was not in recession. Like, it was still growing. So they're distorting interest rates to a level that was far below what the economy needs to function optimally. Again, it's all in my book. So they're distorting what's called the price discovery mechanism of capital markets. They were putting asset prices ahead of the optimal functioning of the economy, right? Because to improve productivity growth, that takes a lot longer in an economy. But you can impact stock prices and house prices very quickly just by dropping interest rates to zero, turning a blind eye to shenanigans going on in terms of people applying for mortgages. They had these things back then in the United States called ninja loans, which was no income, no job, no assets, and people were still getting mortgages. Everybody was turning a blind eye because it was serving to drive housing prices higher and higher. Then the whole housing bubble came crashing down. And there were a number of reasons for it, but the main reason was that the US Federal Reserve, central bank, kept interest rates too low for too long and encouraged the very reckless behavior that caused the bubble in the first place. Rather than say, well, maybe we shouldn't have done that, they doubled down on what some people call the everything bubble. They started printing trillions of dollars to drive all asset prices higher. So, if the stock market is rising because companies are putting capital to productive use, so people save their money, they invest it, companies put it to productive use, they grow the business, they hire more employees, they pay them more, the customers are buying their products. Just like you making your suit, there's real capital being produced, not at the expense of anybody else. And all that will serve to drive the share price of the company up. And if more companies than not are doing that in the stock market, then the whole market will rise in value. That's a true, real wealth effect. Society is becoming wealthier, and it's sustainable because it's a result of investment. But if it's a result of central banks driving interest rates to zero and printing money, encouraging people to take on debt to spend, that's not sustainable. And that's a fake wealth effect. And that's what we've been at. There's still lots of good things going on in the economy, but there's a lot of bad things going on too, because every time stock markets try to deflate to what their natural level would be, the central banks come roaring back with lower interest rates and printing more money to drive stock markets even higher, which does even more harm to the economy. And then just repeat. So that's what we've been experiencing for 15 or 16 years. And as an investor, I was sort of in the trenches and I was witnessing all this, and I was getting so angry because you could see where we would end up, i.e. gargantuan debt levels, productivity growth has been grinding lower for a long time, and absurd levels of wealth disparity. For the top 0.1%, top 1% owns so much of the wealth in the US. There should be wealth disparity based on efforts and ability, but not like this.
Yeah.
Then one of the worst outcomes of this, particularly here in Canada, is the housing affordability crisis that we are experiencing. It's good intentions. I don't believe for a second policymakers tried to create a housing affordability crisis. They thought, well, we'll drive all the asset prices up higher. Boomers like me are going to benefit. And then the benefits of that will all trickle down to the next generation. Well, they haven't, and they won't, right? There's a way to fix this, but it's not going to be pleasant. For a house should not be increasing in value. So remember earlier talking about you make a suit, I make a bike. We both created capital, we make an exchange. I've got a suit now. Why? Because I made a bike. That bike became my means of payment. It didn't come at the expense of anybody else. I created something. So did you. We live in Mississauga, a suburb of Toronto. We bought our house in 2001, my wife and I. If we sold it today, we would get more than 4 times what we paid for it.
Wow.
So over, 24 years?
Yeah.
more than 4 times. What was our contribution to society to warrant making 4 times on our home? Zero. We did nothing. Not like our house became 4 times more productive. It's not like it grew 4 times in size or relocated to a Caribbean island or something like that. It's the same economic good. We make 4 times on our home only because we were fortunate enough to have bought before these fake wealth effect policies of central banks really came to the fore. I'm 63, and all other boomers have benefited from this. We've done nothing wrong. We haven't broken any rules. We play by all the rules. Despite the fact that we play by all the rules and we haven't broken any laws, our benefit is coming at somebody else's expense. If you're looking down on the economy, when you and I exchanged a bike and a suit, you could see that it was real capital creation there. There was none of either. Now there's one of each and we exchange. But when a young couple pays 4 times what we paid for our house, where's the capital creation there? Nowhere. When you look down, all it is a redistribution of capital. And it's a redistribution from the young couple's bank account into our bank account, or a newcomer's immigrant's bank account into our bank account. It's totally unfair. And I mean, I'm sure you've seen the stories, people on social media, young people. No, I've got 3 daughters, all in their 20s. Talk to their friends too. It's hopeless. It's hopeless in the large cities. You know, there are certain parts of Canada where you can still afford to buy a home, but so many people in the large cities would have to move far away from their families, far away from their infrastructure, far away from their friends, from what they know, if they want to be able to afford a home. It's just not fair.
No.
So something needs to be done. There is no easy way out of this, unfortunately. We, as baby boomers, need to stop benefiting at the expense of our children. And if we do not change this, this will be the first time in hundreds of years that the next generation will not be better off than the one that preceded it. And that is a crime to me. We should all be ashamed of ourselves if we allow this to happen.
That's such a powerful statement and such a wake-up call. But how in reality do you see that happening?
I would love to see my house go down in price 50%. Because even in real terms, I still would have made money. I'd love it to go back in real terms of what we paid for it. What you make on your home, if you did any renovations or stuff like that, but your equity nest egg should be the capital that you use to pay off your mortgage, right? Then it doesn't come at anybody else's expense. This is why I've written a book, Stock Markets and Housing, that it'll only happen when enough people understand how they are benefiting at somebody else's expense. I've been talking about this for years with my friends who are all my age, or more or less. And they get it. They get it. And they say, well, if my price of my house has to come down to make it a fair economy, then so be it. Now, there's the odd one who doesn't like it, you know, and there's the odd one who they can't seem to grasp it. Like you grasped it right away. I quote Upton Sinclair, who was a socialist in the US back in the 30s. And he had a line, and the line was, if someone's income depends on them not understanding something, don't expect them to understand it because they don't want to.
Mm-hmm.
Right? It's not that they're not smart. They just don't want to hear it. And I get it. I get it, right? Because it's much harder to take something away from people. Like once they've had it. People factor in the price of their home now into their retirement plans, and they're thinking about what sort of lifestyle they're going to have in retirement. And then I come along and tell them you don't deserve it. But you haven't done anything wrong, but you're living off the backs of the younger generation, right? They're funding part of your retirement for you, and they can't afford to buy a home. People don't want to hear it, but my book is written in such a way that anybody who reads it, if they want to understand it, they will. And I've got great faith in people. Like I really do. And these policymakers who've made these decisions, who've got us into this quagmire, I believe they want to do the right thing too. But policymakers will only do the right thing when we, the people, demand it of them.
True.
And up until now, we've been demanding from them that they do what they've been doing for the last 20 years, drive housing prices higher, drive stock markets higher.
Mm-hmm.
Because we're all making a fortune. This feels great without considering what the longer term consequences are. But if enough people then demand a change from policymakers, then they will do it. And because they're good people. They don't like seeing people suffering. They just don't know how to get out of this. How the hell did we get into this position? How do we paint ourselves into this corner? The first fix is to stop believing in the something for nothing fairy tale, everybody gets a pony doctrine, right? And that comes from understanding how an economy really works. What really, truly drives prosperity? It's people like you. It's people out there who are creating capital, working, strong work ethic, a fair distribution or sharing of the capital that is being produced based on efforts. And for those who can't produce capital, then it's great to be in a situation where we can help those people. Or if they're unemployed, then we can help them for a while. They can be trained, get them back on their feet. Could be an amazing system. And I think it will be. Get people to understand how an economy really works. And then policymakers will do what is needed. And so the first thing they must do is to stop rapidly increasing the money supply. It is very, very harmful to the economy, and that will do away with inflation. But an economy is functioning optimally. You're making suits, I'm making bikes. Companies, what they do is they retain some of their profits, they retain earnings. They reinvest it back in their business, try and figure out how to make things even better. How can I be more efficient? How can I make these things cheaper? And they're doing that because there's competition. So other companies are trying to compete with them. So you have to always reinvest in your business to make your product better, more efficient. So if all of a sudden you're making your product and it's costing you less to make it, your profit goes up. Other companies can see that and they enter your industry to compete with you, and they compete with those profits. The sales price of your product comes down because you got to lower it because you got competition now. So in an ideal economy, instead of slowly rising prices, you should have slowly falling prices. Can you imagine? But this is exactly what the US economy had in the last 30 years of the 1800s. It had massive explosion in productivity in the last 30 years, and the money supply was flat. And so you have the same amount of money chasing that much more goods. So the prices of all those goods had to steadily fall. It's called good deflation. So even if you're on a flat wage, your wages aren't going up, every year you're becoming wealthier in real terms because your flat wage buys more and more stuff. That's the way it's supposed to function. But it doesn't. And the reason it doesn't is because central banks print money at a faster rate than the economy can produce stuff. And so there's more and more money chasing less and less stuff, so the prices have to go up. But they've convinced everybody that you need inflation in an economy for it to function. Because if there's no inflation, then you're not going to be worried about higher prices next year, and you might save your money. It's complete and utter nonsense. So, they come up with this arbitrary 2% target for inflation. And they will tell you that if we have zero inflation, that people will stop spending and the whole economy will spiral down, called the paradox of thrift. So in my book, I use an example of how ridiculous this notion is. Central banks think that if there's zero inflation, that you won't bother buying my bike and I won't bother buying your soup because I don't have to worry about the price going up in the future. I'll just wait, I use the example of 2% deflation. Prices are falling 2% every year. This would be a central banker's worst nightmare. Everybody would stop spending because they're expecting lower prices in the future. Now, let's say your fridge stops working. You need a new fridge, but there's 2% deflation. You're not going to be worried that your fridge is going to be 2% cheaper next year. You need a fridge now, right?
Yeah.
And that's kind of obvious. That's like a necessity. But what about discretionary items? Like, let's say you've got a TV. You think it might be nice to have another TV in the basement for your kids so they're not making a row upstairs. TV is $300. but there's 2% deflation. Now, the central banker will think that you won't bother buying that $300 TV today because you'd rather wait 12 months and save $6 and buy it for $294 next year.
Right. I think people are just going to go buy the TV.
Of course. Like a lot of electronics have come down in price over the years. Like TVs, right? I remember flat screen TVs when they first came out. They're like $3,000-$4,000. And now they're much better and you can get for $300 or $400. The prices were coming down. People didn't stop buying TVs, but they need politicians to believe that inflation is necessary to justify increasing the money supply at a rapid rate. And one of the reasons they do this is because it helps to fund government deficit spending. It makes government debt more affordable to pay off in the future because when you print the money, you're devaluing the money. It's a big problem. It's been a problem for hundreds of years. Like policymakers have always tried to get away with debasing the currency and extracting capital from the system without contributing. But it's just gone into overdrive, in particular since the global financial crisis in 2008 and 2009.
You had mentioned in there, if things could just progress at the natural level that they are supposed to be progressing at, it would be a different world, a different landscape. But us as human beings and our need to want to control everything.
Exactly.
Trying to dictate different than what the natural progression would have been.
That's exactly the issue. There's something called the natural rate of interest. You're just saying natural. And the natural rate of interest is determined by all the market players who have skin in the game, right? You have your own capital, you have skin in the game. Now, when you are making a decision either to buy something or make an investment, you're thinking about the risk return trade-off and how much of my hard-earned capital might I lose here? No, I expect a better return for the risk that I'm taking on. And when you have millions of people making these assessments, it results in the natural rate of interest. This is the interest that is unhampered by policymakers and results in the most efficient economy. But unfortunately, it's not unhampered. Policymakers have been driving it far below the natural rate to encourage people to take on more debt. They've been printing trillions of dollars and buying assets, which drives interest rates down. At the same time, it drives asset prices higher. So they target what's called a neutral rate of interest rather than a natural. So a neutral rate of interest is simply what rate of interest allows for the most debt-fueled consumption without creating inflation that's too high above 2%. But what they've found is that they're all sort of perplexed because the neutral rate for many years has been grinding lower and lower and lower. The rates up here, they drive it down so people go borrow more money and spend and GDP goes up. So they think mission accomplished. But they've driven the neutral rate below the natural rate. Now the economy is operating less efficiently. There's less stuff being produced than there otherwise would have been. People now can't service any more debt and the economy starts to slow. So now they find they have to lower the neutral rate more so people can borrow even more money and spend it. But then it starts to slow again and now we're even further below the natural rate. So it's even more harm to the productive capacity of the economy. And this is what's been going on. Like in the US, you've got debt over 100% to GDP. I never thought I would ever see this. Japan is 250% debt to GDP. Now, all of a sudden, they're starting to have problems with their interest rate situation there. There's no easy way out for them either.
It's a messy situation.
No, it certainly is. But in my book, I have a 10-step plan of how we get out of this. And none of the steps are much fun. I have an analogy. I've been using this with my clients who are financial advisors in Canada for many years. And it helps to explain the importance of dealing with fundamentals rather than focusing on symptoms. So people will accuse me of wanting to see the economy go into a recession and see people suffer and I'm heartless and all this kind of stuff. And how could you do such a thing? Well, because I want to fix the situation. I want to fix the economy. Because yes, it will result in, unfortunately, people losing their jobs today. But if we don't do it, there's going to be way more people losing their jobs in the future. And there could be even social upheaval in the future. I think this is the path we're on unless we change. Look how divided things are in the US and in Canada. Increasingly, we're going that route too. It's so sad.
Yeah.
But anyways, my analogy is you've had a successful career in something and all of a sudden you have this pain in your gut. You don't feel too good. So you go to the doctor. Doctor says, well, bad news, you've got a tumor. The good news is I can operate and I can fix you. And I can return you to health. The problem is that it's a serious surgery and there's going to be a lengthy rehab, 18 months. You're not going to be able to work. The analogy is like a bad recession. And there's going to be contagion. Your family members, due to no fault of their own, they're all going to have to tighten their belt because you're not going to be working. But after 18 months, you have been healed, you go back, work, and it's not up to me to decide how much you should earn or how much you should spend. I just fix you, bring you back to health, and let you decide. And so you say, well, sounds pretty rough, but you know what? Let's get this dealt with. And then they're about to start surgery, and then a central banker doctor walks in. So, hey, what's going on here? Dr. Paul Musson here says that I have to have the surgery, remove the tumor, and I'm going to be out of work for 18 months. Central banker doctor says, oh, don't listen to that quack. I got these magic pills. You take one of these pills, you're going to feel like $1 million tomorrow, right? The impact of printing money and buying assets by the central banks immediately drives stock markets higher. So everybody thinks it's the right thing to do. Feels good, right? You'll take one of these pills, you'll feel like $1 million tomorrow, go right back to work, make more money than you ever made before. Well, that sounds good. But will the pill cure my tumor? Well, not directly, but there will be a health effect, right? Instead of a wealth effect, a health effect. Your body will feel so good, it's going to cure the tumor all on its own. Now you start to get really excited. Well, can I afford these pills? They must be very expensive. Well, no, they're absolutely free, right? You just print the hell out of everything and buy everything that's not nailed down. And so he said, well, I'd like to try one of your pills. You take one of his pills, and just like he said, you do feel like $1 million the next day. You go back to work. You're making more money than ever. You got a bigger house, nicer cars, new friends, right? Everything's hunky-dory. 9 months later, all of a sudden, your productivity starts to slow down again. You don't feel too good in your stomach. Go back to the first doctor. Well, guess what? Tumor's still there. Not only that, but it's bigger. Now, I can still operate, and I can still save you. But instead of 18 months, it's now 3 years of rehab. So the consequences of making the right decision are that much more severe, which makes it that much more difficult to do the right thing.
Yeah.
And now you're so angry with yourself. Why didn't I deal with this 9 months ago? I knew I should have dealt with it, but I let some smooth talking person using financial jargon that I didn't really understand, and they sounded really smart. I let them convince me into trying to take the easy way out. I said, okay, that's it. I'm not doing that. Let's deal with it now, right? I'll learn my lessons. I'm about to take you in for the surgery. Central banker doctor comes back in. Now he's got the QE2 pills. These are much larger than the first, but that was the problem. That's what they always say. The reason we're now back in this mess is because we didn't print enough money. We didn't take on enough debt. We didn't spend enough money. And then you're back there for the QE3 pills or quantitative easing pills. And it's because the pills, the printing of the money, only deals with the symptoms, and it makes the underlying fundamentals worse. But everybody focuses on symptoms, and everybody seems to be doing great until they're not. And now we have the situation, particularly in Canada, particularly in countries like Australia, where you're getting a class war. Like you're pitting generations against each other. It's just morally wrong for no other reason. We should try and fix it, but it won't be easy.
No, it won't be easy. And I've got young kids. My kids aren't even 10 yet. And forward looking, something has to change. Things are moving so rapidly. You using the cost of real estate, for example.
Yeah.
how are my kids? Sure, they'll be fine. I could pass on assets to them. But then I look at their peers. Their generation is screwed right now when we're looking at the way that the monetary system is pulling us, because we're just all kind of along for the ride with it, right?
Yeah, no, exactly. As I said, I think it's just an understanding is sort of the first step
Mm-hmm.
to healing. So the book is published by Unicorn Publishing in the United Kingdom. It's available on whatever book site you like to use, Amazon, or in Canada, Indigo, or Barnes and Noble in the US, and others, with Kindle on Amazon. And then I also have a website where I have a summary of my book and where my blog is. So you can see all my previous posts, my ranting and raving and videos and stuff. And the website is called Paddington Capital MGMT. So MGMT is short for management. So paddingtoncapitalmgmt.com. And you can just put your email in there and you'll get notifications whenever I send out a post, which is usually once a week.
Okay.
I was happy to hear from people if they don't understand something or if they think what I'm saying is nonsense, then by all means, let me know. Yeah, and that's a lot of fun.
Okay, awesome. Thank you so much for joining me on the show today.
Thanks for having me, Jenni. I really enjoyed it.
Thank you so much for tuning in to this episode of the Manifestation and Money podcast. If today's conversation lit a spark in you and you're craving a space to go deeper with your vision, to actually live what you are manifesting, I want to invite you into something really special. It's called the Manifestation Playground, a high vibe monthly membership where you get to experiment with manifestation techniques, connect in intimate pods of like-minded people, and receive direct mentorship from me twice a month inside our cozy Zoom room. This is where your dream life stops living in your journal and starts showing up in your reality. Vision, energy, accountability, it's all happening inside the Manifestation Playground, and your group might be forming right now. Just head to www.manifestationplayground.ca or click on the link in the show notes to learn more and save your seat. And remember, your vision isn't random. It is your future waiting for you to believe in it. I'll see you next time, or inside the playground.